Hey there guys, so listen, before we start today I just want to make something really clear because there's still a few people watching this show and seemingly watching every single episode apparently, enough to be able to comment on some of the videos and send me emails that haven't quite understood the concept of what we're doing here. This show is for me a very selfish process in so much that I am an investor that's looking to invest in a company over the next 10, 20 years. So for that, I'm looking for companies that are probably going to grow 300 to 400% over that period of time. Now, in order to put myself in the best position possible and to give myself the best odds possible to achieve that, I'm looking for a very high caliber of company. That's all I'm looking for. I'm looking for the best of the best. I'm looking for companies that have huge profit margins. I'm looking for companies that are reinvesting those profits back into the business for future growth. They've got to have huge enough profit margins to be able to have the money to be able to do that. I'm looking for companies with revenue growth. You know, I'm not interested in companies that really aren't growing very much or certainly going downhill. Not interested. I want companies that are growing. I want companies that have a very rosy future ahead of them so that they can achieve that 400% return over the next 10, 20 years. Not every company I pick are going to achieve that, I know. But I am looking to raise the odds of that happening by just picking the companies that tick all of those boxes. By doing so, I'm dramatically increasing the odds of being able to find the right businesses, to put them into my portfolio, to invest in their shares, to buy their shares, buy slices of those companies, and put myself in the best position to achieve the numbers I'm looking to achieve. And so far, over the last 7 years or so, it's been working very, very well for me. Some people are watching this show and they're thinking it's simply a review show on the company's potential to be good investments. That's not what this show is about. And so when we looked at Luceco last week and we scored them 61 points and we put them up on the leaderboard and they weren't top, I started getting the odd email from people saying, "You've missed a massive trick there. You don't know what you're talking about. These guys are going to be great." Well, that may well be. I've had other comments from people saying this guy doesn't know what he's talking about. That may well be. I've had other comments from people saying this guy has no idea what's going to happen on the stock market. Why are you listening to him? That is absolutely the truth. I do not know what's going to happen on the stock market. I am simply trying to increase the odds of me doing well over the next 10 or 20 years by looking for just the best companies I can find. So that means that if a company doesn't tick all those boxes, I'm not interested and they're going to score lower. So the people that are watching this show and thinking or have the wrong perception of what this is about, I want to make it absolutely clear. This show is for me, primarily. Very, very selfish. I'm sorry. The point here is I'm looking for companies for me. I'm looking for companies for the kind of investor that's going to be sticking around for 10 to 20 years. You know, some people say to me, "You wrote off Aston Martin a few weeks back and their share price is already up 10 pence. Sure, Aston Martin might go up another couple of quid for all I care, but the odds are against them being a 300% growth company over the next 10 to 20 years. People are even going to argue of that, but the odds are against them. They haven't even had a profitable year in the last 4 years or whatever it is. You know, so until that starts to happen, I'm not interested. Yet I've had a relatively borderline hate emails from people saying that I don't know what I'm talking about. Aston Martin are going to be great. You know what? Great. Go for it. You know, there's enough stocks out there for everybody. My point is they don't tick the boxes for what I'm looking for. And I'm not going to invest in companies just because people want me to. You know, it's mental. If you don't like it, then do your own research. And if you like them and I don't, that's absolutely fine with the world. I'm sure the universe is not going to explode based on the fact that Chris doesn't agree with you. But I want people to understand what I'm actually doing this for, what I'm looking for in these companies, why I'm looking at these companies, why they're scoring relatively low, why they're scoring relatively high. It's not just because they're good investments or not. These companies that are scoring high have great odds of being the 300, 400% companies that I'm looking for. They may not all be them, but they have increased odds of being them. And that's the best we can do in the environment that we have, in my opinion. Now, if you're interested in finding out what these companies are, this is the show for you. If you're interested in picking a company and riding it for 3 or 4 weeks in the hope that it's going to go up 50% over the next few weeks, this is not the show for you. I'm not going to be finding those companies. So I wanted to make that extremely clear at the beginning of this episode, because we still seem to be finding people on YouTube that really haven't quite grasped what this show is all about, and very quick to leave a negative comment about how, I don't know what I'm talking about because this stock's gone up 10 pence over the last week. Sure, but will it go up 300, 400% over the next 10 or 20 years? That's the point. That's the difference, right? We're all doing something different. Many investors out there have completely different strategies. Totally cool with me. No skin off my nose what you do. I'm just doing me. I'm just doing what I do. So with that in mind, if you've realised that this is no longer the show for you, fine. However, if you want to come with me on this journey to find these companies that have the greatest odds of achieving these great growth rates in share price, then I implore you to come with me on this journey. Today, we're going to take a look at Experian PLC. Hey there, guys. Thank you for bearing with me during that massively long intro. I'm not going to waffle on much longer. We're going to look at Experian PLC today. They're a very good company, very good numbers. Let's dive into those numbers right now and get going with the analysis. Okay then, guys, let's take a look at Experian PLC, Epic code EXPN. They're in the FTSE 100 in the support services sector. So the first thing that stands out for me is the revenue between 2008 to 2011. We're looking at 3.8 billion in revenue, and it was stuck there for 4 years, not really able to move. Then we saw quite a considerable jump in 2012 up to 4.4 billion. So, that's a quite considerable move. And then 2013, another jump up to 4.7, and then since 2014, and this is probably the first concern that comes to mind here, is that we haven't really gone anywhere. 4.8, down to 4.2, up a little bit to 4.3, 4.5, back to 4.8. So from 2014 to 2019, over the last 6 years, they've been stuck at 4.8 revenue or lower. Now, 4.8 billion in revenue is fantastic. It's a fantastic sum of money. But what I'm concerned about there, or the main concern, is just the lack of growth, the lack of opportunity, or the lack of ability, I should say, for experienced staff, people to get out there and find more business, bring more business in. And when I'm looking for amazing stocks, I expect to see that. I expect to see revenue growing, companies continuing to grow. This doesn't make them a bad stock. It just means that they're not ticking that box. Looking at expenses, no issues with expenses at all. In fact, they've come down. They were at sort of around 60% from 2008 to 2010. Then we've seen the expenses fall to 55% of the gross profit back in 2011, and it's pretty much stayed there consistently since then. Since over the last 9 years, we've been sitting at about 55% of the gross profit being used for expenses, and that's a healthy figure. 55% expenses is pretty good. So what it means is that there's a chunk of profit still to be kept by the shareholders as we go through this. We've got no issues around R&D. We've got no real issues on depreciation. It has gone up as a percentage of the gross profit. So of course we would expect depreciation to go up, but has it gone up faster than the gross profit? The answer is yes, it has, which is a slight concern, but we're still within levels that I would be more than comfortable with. We're looking at about 13% of the gross profit being spent on depreciation and amortization costs. So that is fine. If that was to continue going up and up and up and up, then I'd have a concern. But it's something to keep an eye on for now. But right now, it doesn't make them a bad company, and it doesn't really cause many issues for me as an investor. Looking at the interest on debt, this is a little bit more important for me. And we've seen some steady growth here, really. Back in 2011 to 2013, we did see it jump up from 15.8% to 38% of the operating profit. And those are far too high for me. So interest on debt was very high between 2011 and 2013. Then it seemed to kind of get under control in 2014, down to 2.9% or 47 million out of the 1.6 billion operating profit. So, at that point in 2014, Experian operating with very little interest on debt, no real issues there. However, since then we've seen it grow. We've had some kind of dips as well. 2017 dropped to 0.6, but 2019 we're now back up to just shy of 14%. So it's 208 million out of the 1.5 billion. So again, it's not a huge amount, and it's still not at a level that I'd be concerned with. What I'm more concerned with is the lack of revenue growth and the increase in depreciation and interest on debt costs. So these costs are going up, but the revenue isn't. So that's a slight concern for me. Expenses staying pretty much level over the last 6, 7, 8 years. So that's going to paint a certain picture. When we look at the net earnings, then we come down to what's actually been achieved by the business. Very, very good. Pretty happy with these numbers. We're looking at, on average, I haven't worked this out, but let's do that right now. I'm reckoning about 25%. 24.8% average annual net earnings over the last 10 years, pretty much. So we're looking at an average of about 25% a year, let's call it. So that's pretty good. That's the sort of level that I'd be looking for as an investor. I'd be very happy with a company that's making 25% net earnings a year on average. One slight concern, the last 3 years, we've seen 3 continuous years of it falling. So it's gone from 27.3% down to 24.7% in 2018. And then in 2019 down to 21.3%. And it hasn't been that low since 2013. So it has dropped, unfortunately. So looking at just the income statement, the basic picture here is that revenue is flat. Expenses are flat. The depreciation is climbing, the interest on debt is climbing, and the net profits or the net earnings has been falling over the last 3 years. So some slight concerns, but all of these figures are within the kind of threshold that I'm looking for. So nothing is at a bad level yet. It's just the trends that I'm concerned about, the trends slightly going in the wrong direction. Looking at the balance sheet, I've got an issue here with the current assets against current liabilities, what I've always known as the current ratio, which is down to 0.4. So if we actually have a deeper look at that, the current liability is sitting at 2.8 billion. So these are liabilities due to be paid within the next year or so, and then assets that can be turned into cash within the next year or so, only sitting at 1.2 billion. So that's 2.8 compared to 1.2. It's given them a very low current ratio rate of 0.4. Obviously, what we're essentially talking about here is that the current liabilities outweigh, completely double, the current assets at the moment. So that's a concern for me. I don't like to see that. We've also seen that pretty much on a downward trend now since 2015. So it was sitting at a relatively healthy 0.8 current ratio. I mean, even then it's pretty much scraping the barrel, but from 2015, 2016, 2017, 18 down to 19, we've seen it fall all the way from 0.8 to a more dangerous level of 0.4, and that's a concern for me for sure. Looking at the long-term debt, not a big deal. We're sitting up at 2.4 billion. So when we bear in mind that this company is making, in terms of net earnings, about 1 billion a year at the moment, that's going to take them about 2.5 years based on current earnings power to pay that off. I'm cool with that. That's not an issue for me as an investor. That's it's obviously sizable, and the level of the debt is obviously having an impact on the profits in terms of the interest that they're paying on it, as we've seen on the income statement. But at current levels, that's not a big deal for me. The other concern I have, therefore, is the shareholder equity. So this is the assets minus the liabilities. We've seen the equity sitting at 3.2 billion in 2013, down to 3.1 the next year, down to 2.8, 2.4, where it's pretty much stayed then since over the last 4 years. So equity is not rising in this company. So that's another little concern, because I like to see companies where the equity is going up. So want to make it clear here at this stage, this doesn't make them a bad company. They're doing very, very well. This is a company, guys, making 25% a year, so you really can't argue with that, right? presently falling down to maybe 20% a year, but they might have a great year in 2020, who knows. But just looking at historical data over the last few years, things pointed in the wrong direction. Not much growth, lots of kind of stagnant figures staying at the same level or going down, nothing really going up. And that is the kind of underlying concern there that just keeps me away from this company. It just keeps me a little bit, stops me from putting my money into Experian. I'm looking at all the other numbers, very easy to get tempted by this business, and clearly making some great profits. But my concern is the fact that over the last 4 years, we've not seen it go anywhere. And if they're going to struggle to grow from here, where do they go? Where does Experian PLC go from here? Retained earnings has pretty much sat at the same level now for the last 5 years at about 18.5 billion. So listen, they've got a huge ton of money sitting in their retained earnings. This is a business that is doing very well, has been doing very well for a long time. Any company sitting on 18.7 billion in retained earnings is clearly doing something right. Listen, I'm looking for a company that's going to go up maybe 300, 400% over the next 10, 20 years, right? I want an average annual return of, say, 15% would be good for me. I'll be happy with that. So I'm looking for companies that are going to do that. My concern here with Experian is that they may not be that company purely because over the last 4 or 5 years, they've not grown. They've not gone anywhere. In fact, things have started to go downwards. And so for me, that's an early indication that they're not quite the business I'm looking for. When I've got a portfolio of 40-odd companies that are showing all the signs of what I'm looking for, when I look at a company like Experian, I'm looking at a very, very solid company, a very solid business. But my only concern is, are they going to grow much now from this point onwards? Is there any room for their growth? Return on shareholder equity is very, very strong. And really the only bad thing I can say about Experian is just the lack of growth. That's it. Everything else is looking really, really good. Let's take a look at the share price. Okay, so we're looking at a monthly chart of Experian, and you can see here there's been a very good growth stock over the last 10 years or so, from 2010 to 2020. Very, very good. And despite the kind of the stagnant revenue or lack of revenue growth, and the increased depreciation, the increased interest on debt, the net earnings that are falling, they've still been going up in value. They've still been climbing. They're sitting at £27.50 per share. This is clearly a very successful business, earning fantastic returns for shareholders at 25, let's say call it 20% right now. Returns for the shareholders. Fantastic results, and this is a very, very good company. Unfortunately for me, they just don't quite make it. They're just too many concerns in there. When I have a selection of companies that don't have any concerns for me, where they're showing all of the right trends in the right direction, and they're hitting these 25, 30, 35% net earnings, but also growing at the same time, and all the numbers are climbing, then a company like Experian don't quite make it into my portfolio, purely on the fact that I've got concerns, will the share price continue to grow from here? And we'll take a look at the share price in a moment. Okay, so very positive numbers here. Very much like Experian, have owned shares in Experian before and have backed away now as an investor, purely because they're no longer ticking all the boxes, and because some of those trends in there are slightly concerning. Now, again, want to make this really clear, like I did at the beginning of the video. This doesn't mean they're a bad investment. That doesn't mean that this company can't go up in share price value. What it means is that the odds have now reduced in them being a potential 300 to 400 growth stock, 300 to 400% growth stock company over the next 10 to 20 years. They may still achieve that, but the odds have reduced. And as a result of that, I'm putting my capital in companies where the odds are greater. Hope that makes sense. So I'm not saying that Experian are a bad company at all. They're a very good company. They just don't tick the boxes for me. They unfortunately come a little bit short. Another concern for me as well, bear in mind that some of these numbers are going down and these trend numbers are going down. The share price is very high. We're sitting at £27.53 a share right now. Well, the earnings per share that this company are making, 76 pence a share. So bear in mind we've got a share price of £27.53. That means that if you bought all the outstanding shares in this company, the earnings per share you'd be making on a yearly basis, based on today's price, if you bought the company at today's share price and bought all those shares, you're looking at a 2.7% return, which is really low. And what that suggests is that the share price is far too high. Looking at the assets per share, or I should say the net assets per share, otherwise known as the equity or the book value, we're looking at, once you've taken the equity of the company, split that down by all the outstanding shares in the company, you're looking at £2.64 per share in equity. That's an equity rate of £2.64 per share. Again, when we're dealing with a company with a £27 share price, that suggests to me that the Experian share price is way too high relative to the company's intrinsic underlying value. And that would concern me as well, because when you've got the last couple of years where some of these numbers are starting to tail off and the revenue's not growing and the company have kind of reached this plateau and depreciation's rising and expenses and all that kind of stuff, the interest on debt's going up and it's costing them, the net earnings slowly dropping off a little bit, and we're at such a high share price of £27, which is way too high relative to the intrinsic underlying value of this business. That would indicate to me there's too many boxes there that are concerns, and it would indicate that maybe these guys probably not going to be a 300 to 400% share price growth. Maybe they've done all the growth that they're going to do, or a large chunk of that growth, and they've started to reach this plateau now, and that happens with some companies. So for me, they're not quite as strong for that reason. Let's get them up on the board. So Experian, Epic code EXPN. Still a great company, and I'm not putting them down in that way. They're just not quite right for me. And the score that has been generated based on all my algorithm, all my measurables that I look for, has priced them, I would say, quite fairly. We're looking at 55 points. So let's get them up on the leaderboard. Okay, so we're getting a little bit crowded on the board, even though we're not really adding any companies to this now. But we've Experian falling at 13th place. Respectable 13th place. Bear in mind, this board is getting stronger and stronger now every week, because we're relegating the lowest company off the board, providing the price that the points come in above that, and so we're slowly getting a stronger and stronger board here. 13th place is respectable. They come in above Carnival, above ITV, above BT, and sitting there with the likes of WH Smith and Luceco. So another good solid company. I'm just concerned about the price being a bit too high, in fact incredibly too high for me right now, based on what I look for in price, and some of those negative trends that are moving in the wrong direction over the last 3 years is also a concern for me. But otherwise, could be a very good solid investment still. We lose Vodafone. These guys are gone. And the board is getting stronger as we go. Thank you so much for watching, guys. Thank you for listening to me waffle on at the beginning of the video. I hope you are finding these videos useful, and I'll see you guys on Thursday for the next company that we look at. Cheers, guys.